Hello and welcome to this episode of TNT. My name is Dennis Maynard. I am a real estate broker here in Los Angeles, California. Since the beginning of the year, we have seen the stock market enter into a correction, albeit we don't know how big of a correction. The bond market has fallen, pushing yields higher, and mortgage rates have climbed. Most of the movement was initiated prior to Fed Chair Powell's presser, but definitely more movement since then. We are going to be building on the concepts that we discussed in Inflation Unleashed. Much of the current causes of inflation I covered just a few weeks ago. You can click the link above to watch that episode if you need more information. Rising rates are the result of inflation that we have been seeing, which is largely at its highest since the 1980s. I wish I could say that inflation was over. I cannot. The Federal Reserve and Congress have added over 17% to the M2 money supply, essentially printing money maybe closer to 20% by March 2022. We have not seen this type of printing in a long time, but I have heard commentators say that the 1940s and the 1970s are similar examples. So, we can look at history to understand not only how we got into this, but how are we going to get out of it? It's clear the stock market loves its quantitative easing. You did good, Jerome. So how do we get out of inflation created by printing money? First, we have to stop printing money, which is why the Federal Reserve is ending QE. Next, the Fed will have to raise the federal funds rate, aka the overnight rate, and increase the reserve requirements at banks. Last, they will begin to sell or close out some of the holdings on their balance sheet without replacing, or they will roll the assets. These actions will take money out of the system or at least curb some of the increase. This ultimately gets us to how the massive money printing is stopped. You have to deflate the economy or slow the price increases to slow inflation. This is largely why markets are starting a correction. Right now, we are still in an inflationary rise, and the Fed will begin to slow the rate of inflation. We're going to take a look at how rising interest rates affect home prices in an inflationary environment with lots of cash floating around and not much supply. We will look at these in three parts: affordability, mortgage rates, and prices. Then we will try to deduce how much pricing change will follow in a money supply contraction. We will wrap everything up with a discussion on the time and how long it takes. This is not an absolute. There are many factors at play. Don't forget to like, subscribe, and follow. Let's get started. To determine home affordability, we're going to look at the National Association of Home Builders and Wells Fargo Housing Opportunity Index. The National Association of Realtors also has an index. The HOI for a given area is defined as the share of homes sold in that area that would have been affordable to a family earning the local median income based on standard mortgage underwriting criteria. There are really only two major components: income and housing cost. Here you can see the broad range of affordability throughout the U.S. expressed as a percentage of the population that can afford a median-priced home. The most affordable metro is in Illinois. The least affordable, just about all of California. Since we are in Los Angeles, here is the Greater LA Index since 2012, right after the Greatest Recession, when it was most affordable to buy, to now being next to last in the country. As we look at the entire country, California is the least affordable state in the union. There really only is one point I want to glean from these slides. The least affordable areas and states will likely be impacted the most by increases in the mortgage rates. Mortgage rates have an impact on how much a buyer has to spend each month to own a home with a loan. The 10-year Treasury has been considered a quasi-proxy for mortgage rates. The spread between the two has been fairly consistent over time. As we zoom in, we can see that there have been slight variations, but the move in the 10-year Treasury is pushing mortgage rates higher. As for the current rate, it's sitting at 3.55%, up from 2.875% in 2021. The bond market has moved aggressively to adjust to the new market realities of no more free money. This is a snapshot of the total mortgage-backed securities being held by the Fed. Not only are they intending on not buying more, but they are also going to roll off all the securities held as well. The suggested result is that the MBS will be solely at the discretion of the market, and rates will rise over time. Many people assume that as mortgage rates rise or decline, it's a one-to-one move in price as well. In this chart, we can see how prices and loan value, deposits, are all moving together lower as rates increase. If we look at this concept from a different point of view, purchase prices will decline and monthly payments will increase as interest rates rise. The increase in monthly payments is what drives prices lower. Part of the reason for this is wages are typically slow to change. So, if the cost of housing increases dramatically, then prices have to adjust to meet the percentage of wages available for housing. This concept of prices not changing quickly is known as sticky prices. According to Investopedia, price stickiness, or sticky prices, is the failure of market prices to change quickly despite shifts in the broad economy suggesting a different price is optimal. Often, stickiness works in one direction. Prices rise more quickly than they fall. This is true of both housing and wages. Both share a common characteristic that they are both change very slowly over time. Homeowners don't buy and sell every day, just as employers don't reduce wages when sales fall. So, both are sticky. As we look at the blue line, this is the original change in price. It assumes that down payment and loan size will contract as interest rates rise. In reality, a person with a $200,000 down payment for a $1 million property will have the same for a $900,000 property. One has to assume that buyers will still use that down payment in a supply-constrained market. So, the amount prices will contract will be less. This is demonstrated by the orange line. Note it falls at a much slower rate. But wait, there's more! Due to a lack of supply, we can assume that there will be a slightly higher purchase price despite increased rates. Using a standard deviation, we can see that the pricing represented on the yellow line. Effectively, if mortgage rates move from 3 to 4%, we could see a 7 to 8% decline in prices. Now, that's what the model suggests. Is it right? I don't know. We absolutely can deduce that the cost of homeownership is going to rise, and this will have an effect on prices. In the event that interest rates move back above 2007 pricing, or 5%, then we will see some movement in pricing. Typically, when mortgage rates rise, buyers rush into the market to purchase and prices rise further before they pull back some. If interest rates do rise above 5%, then the monthly mortgage payment of the cost to a homeowner would be approximately 20% more. This would cause prices to trend lower as much as 17%. Remember, The only thing we can ascertain for sure is that the cost of ownership it will rise. Why are we not certain that prices will fall as the model says? Time and supply. Remember, we are in an extremely tight housing market. Year over year, inventory has fallen to new lows in December 2021. At the same time, 40% of homeowners own their homes free and clear. Of the homeowners that do have mortgages, 35% or more have more than 30% equity in their homes. Less than 7% of homeowners have less than 10% equity. What does this mean? People don't have to sell their homes right away. The least affordable markets will be affected the most as the number of buyers available to purchase dwindle. Affordable markets will likely be hurt less as people adjust to the new rates. This means that even if rates increase in the short term, it will take time for all of this to work itself out. And the Federal Reserve may take action to prevent long-term decline in the housing market. Even if interest rates spike to 5% next week, we wouldn't see the results of that for a good amount of time because homeowners don't need to sell. This is not the same situation as it was in the housing crash of the Great Recession. And for those of you who are trying to bargain shop, you are fighting against a higher monthly payment. Rates come and go in cycles, and only time will tell for sure which way it's going. The Fed will have to curb inflation as there is just too much money in the system. The action itself is deflationary as they pull money out of the system or let it stagnate to catch up. Housing prices will be impacted in the future, but it will be relevant to the affordability of the area. We can expect that the cost of homeownership will rise in the near future. I hope this helps your thinking on how to approach rising rates. What are your thoughts on the rate hikes? Do you think that we'll be seeing housing prices fall? Please leave your comments below, and I will see you on the next TNT.